Hello, I'm Charles Leyland, Managing Director of Leyland Private Asset Management. On our website, we've got many books in our recommended reading list, but unless one is as passionate about the share market as some of us here are, it's probably far more important things or more enjoyable things for many people to read. So what I thought I'd do today is to summarise Chapter 12 of The General Theory of Employment, Interest and Money. So this book was written in 1936 by John Maynard Keynes and is a staple really for any student of economic history. Keynes is a big believer that you can control the economy using monetary policy. I don't necessarily agree with a lot of things that he says. However, Chapter 12 is very important as it actually relates to the share market and importantly to the irrationality that can occur in the share market. And this is actually on Warren Buffett's recommended reading list as well. So it plays through. I think you'll probably realise in a lot of our writing, a lot of our thinking, that the same themes are playing through fairly frequently, albeit they're coming from different people, different ideas, different ways of saying similar things. So I've got the 1947 version here. I didn't want to write all about it. You can download this for free on the internet, and this is where I've made my notes. At the start of Chapter 12, stated the state of long-term expectation. Keynes basically says, look, the considerations with expectations to prospective yield partly based on existing facts, which we can assume to be known more or less for certain, and partly on future events which can only be forecast with more or less confidence. And he essentially says that the greater the confidence with which you can forecast, the more you can basically invest on that basis. But he's very, very honest with saying that the longer you go out, the harder the forecast is to make. Notwithstanding that you might have done the best analysis in the world, and even since this was written in 1936, we're now here in 2016. The same mistakes are being made. The models have improved. We've now got computers and Excel spreadsheets, but that's still only the engine. It's still the garbage in, garbage out adage, which has been around for forever. So he talks about the state of confidence is a matter which practical men always pay the closest and most anxious attention to, but economists generally ignore this fact, and is very honest, really, coming from an economist. He said that economists have not analysed it carefully and have been content, as a rule, to discuss it in general terms. He also says the ensuing digression in this is on a different level of abstraction from most of the book, because the share market, by definition, is fairly abstract. It's hard to actually put an absolute mathematical reason behind every move in the share market, as anyone that's invested in the share market would know. So the outstanding fact is the extreme precariousness of the basis of knowledge on which our estimates of prospective yield have to be made. Our knowledge of the factors which will govern the yield of investment some years hence is usually very slight and often negligible. This is Keynes, one of the famous economists. If we speak frankly, we have to admit that our basis of knowledge for estimating the yield 10 years hence of a railway, a copper line, a textile factory, the goodwill of patent medicine, Atlantic liner, a building in the City of London amounts to little and sometimes nothing. So that's a pretty honest premise by which you're entering this. Keynes then talks about historical investment, predating share markets. And that would still relate, I guess, to private investments which are unlisted, in which one puts their money in, and the expected outcome is directly a result of how that investment has occurred, how that business has occurred, how that property's performed, what have you. And obviously, the parallel to that is the security market, because the shares are revalued every day. So over on one side, the business is operating, it's doing its thing, hopefully growing earnings as expected, but the short-term variations in the share market often bear very little resemblance to what's actually happening with the underlying business in the short term. So in the absence of security markets, there is no object in frequently attempting to revalue an investment to which we are committed. But the stock exchange revalues many investments every day, and the revaluations give a frequent opportunity to the individual, though not to the community as a whole, to revise his commitments. It is as though a farmer, having tapped his barometer after breakfast, could decide to remove his capital from the farming business between 10 and 11 in the morning and reconsider whether he should return to it later in the week. There is no sense in building up a new enterprise at a cost greater than that at which a similar existing enterprise can be purchased, is the next major point that he makes. He's saying there capital is limited, and sometimes it will go into the share market where you can buy a second-hand investment, if you like, for cheaper than that which you could go and buy a new investment. And that waxes and wanes over time. So certain classes of investment are governed by the average expectation of those who deal on the stock exchange as revealed in the price of shares rather than by the genuine expectation of the professional entrepreneur. How then are these significant daily, even hourly revaluations of existing investments carried out in practice? So this is where it starts to get interesting. So he's broken these down into sections. We're now up to section 4. Really, in that section, he basically says all sorts of considerations enter into the market valuation which are in no way relevant to the prospective yield, and he runs through a lot of those. Section 5 is probably the most relevant to this discussion. Some of the factors which accentuate this precariousness may be briefly mentioned. The first point that he makes is that as more of the equities are owned by people who do not manage or aren't close to the business or have any real knowledge in the valuation of investment, this can actually cause volatility, because the greater the ignorance, the greater the volatility. 2, day-to-day fluctuations in the profits of existing investments, which are obviously of an ephemeral and non-significant character, tend to have an altogether excessive and even an absurd influence on the market. He brings a couple of examples of an ice manufacturer having a higher share price in summer than in winter, and the recurrence of a bank holiday increasing the valuation of the British rail system. Obviously, it's fairly old, but more people would actually be travelling. Number 3, mass psychology of a large number of ignorant individuals is liable to change violently as a result of a sudden fluctuation of opinion due to factors which do not really make much difference to the prospective yield, since there will be no strong roots of conviction to hold it steady. So if you're buying a share and you don't really understand the business very well, you'll probably follow the flow. You'll assume that the market knows more than you do, and you'll just go with the herd. So waves of optimistic and pessimistic sentiment, which are unreasoning and yet in a same sense legitimate, where no solid basis exists for a reasonable calculation. Comes back to that point before. But there is one feature in particular which deserves our attention. It might have been supposed that competition between expert professionals possessing judgment and knowledge beyond that of the average private investor would correct the vagaries of the ignorant individual left to himself. However, the professionals are largely concerned not with making superior long-term forecasts of the probable yield of an investment over its whole life, but with foreseeing changes in the conventional basis of valuation a short term ahead of the general public. He's essentially saying many professionals are in there with the average sort of day trader, as they'd be called now. And we see this often happen with recommendations from some of the larger brokers, where the price targets are very short-term price targets and driven by sentiment. Sometimes the price target might be increased because the PE multiple's increased. Essentially means the price has gone up, therefore the target price has gone up. So this sort of behaviour and thinking is still pervasive, despite all the lessons that we've actually learned. The battle of wits to anticipate the basis of conventional valuation a few months hence, rather than the prospective yield of investment over a long term of years, does not even require gulls among the public to feed the maws of the professional. It can be played amongst professionals by themselves. The metaphor which Keynes uses, it is a game of snap, of old maid, of musical chairs, a pastime in which he is a victor who says snap, neither too soon nor too late, who passes the old maid to his neighbour before the game is over, who secures a chair for himself when the music stops. The games can be played with zest and enjoyment, but players all know that the old maid is circulating. A second metaphor, which is a bit deeper and fascinating. It seems as though back in the time this was written, they would have and the newspaper would have 100 faces, and the competition was to pick out the 6 prettiest faces, prize being awarded to the competitor whose choice most nearly corresponds to the average preference of the competitors as a whole. So therefore, the competitor is not necessarily picking out the faces which he himself finds the prettiest, but those which he thinks likeliest to catch the fancy of the other competitors, all of whom are looking at the problem from the same point of view. So it's actually not even a case of choosing whose face is the prettiest on your own judgment, not even but only the average judgment, or what the competitor thinks the average judgment will be. So this is a third degree where we devote our intelligence to anticipating what average opinion expects the average opinion to be. And Keynes believes that many professionals go down to the fourth, fifth and higher degrees of trying to anticipate what the crowd will anticipate. Keynes then talks about the problem of being a long-term investor, managing your own money or managing other people's money. He basically said the desire for short-term results is so pervasive that life is sometimes not long enough. There is a peculiar zest in making money quickly, and remoter gains are discounted by the average man at a very high rate. The game of professional investment is intolerably boring and over-exacting to anyone who is entirely exempt from the gambling instinct. Finally, it is the long-term investor, he who promotes the public interest, who will in practice come in for the most criticism wherever investment funds are managed by committees on boards of banks. For it is in the essence of his behaviour that he should be eccentric, unconventional and rash in the eyes of average opinion. If he is successful, that will only confirm the general belief in his rashness. And if in the short run he is unsuccessful, which is very likely, he will not receive much mercy. And this is a great saying. It says, history teaches us that it is better for reputation to fail conventionally than to succeed unconventionally. And sadly, again, that's pervasive with a lot of the market today and a lot of fund managers today. Keynes then reverts back to bemoaning capital allocation in part 6 and part 7, saying that the share market can sometimes be taking away capital that could otherwise be directed to greater growth. He then says that one of the benefits is that liquidity in the share market perhaps stops the hoarding of cash. Thinks investors will actually do something. They'll invest in the share market instead of perhaps hoarding. In part 7, he actually talks about the psychology again, where he says a large proportion of our positive activities depend on spontaneous optimism rather than on mathematical expectation. And he actually brings this back to the issue of floats, whereby you do need a lot of short-term optimism because you are believing the numbers that are coming out in prospectuses, etc. It says enterprise only pretends to itself to be mainly actuated by the statements in its own prospectus, however candid and sincere. Only a little more than an expedition to the South Pole, it is based on an exact calculation of benefits to come. But he also points out the fear of loss may have a basis no more reasonable than hopes of profit had before. It's just a matter of being sanguine in one's expectations of extreme forecasts, one way or the other. So the state of long-term expectation is often steady, and even when it is not, the other factors exert their compensating effects. This is over the long term. We are merely reminding ourselves that human decisions affecting the future, whether personal or political or economic, cannot depend on strict mathematical expectation, since the basis for making such calculations does not exist, and that it is our innate urge to activity which makes the wheels go round. Our rational selves choose between the alternatives as best we are able, calculating where we can, but often falling back for our motive on whim or sentiment or chance. So that's Keynes. It talks about the never-ending problem of market psychology, and you'll see in a lot of the books that we recommend, they're not necessarily finance books. A lot of them do relate to human psychology and the power of mass psychology. But as Ben Graham says, in the short term, the market's a voting machine. In the long term, it's a weighing machine. It means that it's another way of saying in the short term, trends will go up and down, stocks will come in and out of favour. But in the long term, you own a business, and the quality of the earnings of that business will eventually be reflected in the share price. So that's it from me. I hope you enjoyed this, and I hope to be able to speak to you again. Thank you.